Have you ever stopped to think about the actual nervous system of the Indian economy?
I mean, most people don't.
Right. We all use money every single day. We swipe cards, we scan QR codes, we obsess over our savings account balances. But have you ever wondered how a simple piece of paper in your pocket dictates the fate of nations?
Or why the cost of your home loan is, actually decided by a meeting in Mumbai that you were definitely not invited to.
Exactly. It's wild when you think about it. And today, we aren't just talking about money, we are talking about the architecture that keeps it moving. The Indian banking sector.
The heart pumping the blood.
Yes. So welcome everyone to this special deep dive focused on the full summary for UPSC by the Simplified UPSC by PPP YouTube channel.
It's a real pleasure to be here. This topic can seem dry on paper, but when you realize it affects everything from the price of onions to the stability of the rupee, it becomes incredibly gripping.
Absolutely. Now, before we unlock the vault and get into the good stuff, I have a humble request for all you learners out there. If you find value in this deep dive, please hit that subscribe button. It genuinely helps us keep the lights on.
It really does.
And if you are capable and enjoy our work, please consider supporting us on Patreon so we can keep bringing this super useful content to you.
These deep dives take a massive amount of research and production effort. Your support is literally the infrastructure that supports our infrastructure.
Well said. I also want to give a warm, energetic shout out to all our current supporters.
Yeah.
You are the fuel for this engine, and we appreciate you immensely.
Huge thank you to all of you.
And to everyone listening, don't forget to like the video and share your valuable comments below. I actually want to ask you right now, what is the one banking concept that always confuses you? Is it the repo rate? Is it NPAs? Let us know in the comments.
I'm betting on the bad bank concept. Or maybe the nuances of Basel Norms. Those always seem to trip people up.
We will find out. And speaking of clearing up confusion, I have one more crucial announcement. Free notes with practice fear questions, or PYQs, are available right now on our Telegram channel.
Which is such a good resource.
Oh, it's amazing. But for those who want the full archive access to all videos in this series and the organized premium notes, which include detailed notes, extra PYQs, and Model and Mains answers, join us on our private Telegram library. You can DM us on the public Telegram channel to join.
That sounds like an invaluable resource for anyone serious about mastering this subject. The mains model answers alone are worth their weight in gold.
They really are. Okay, let's get into the episode overview. Today we are dissecting Chapter 15, which covers banking, from Sanjeev Verma's Indian Economy.
But we aren't stopping there, are we?
No, we are bringing in the big guns.
We are going to layer in some conceptual clarity from Vivek Singh's Indian Economy as well. Because Sanjeev Verma gives us a fantastic structural overview, the what and the where. But Vivek Singh is excellent for understanding the mechanics, the how and the why. Things like Basel Norms and how repo rates actually function. We want to ensure those difficult concepts are crystal clear for you.
So our mission is to move beyond just definitions. We want to really understand the structure, the reforms, and the future of banking in India, covering everything from the RBI's liquidity tools to the massive merger of SBI.
Let's start at the very foundation. Segment 1, the architecture.
You can't fix a car if you don't know what is under the hood. So let's pop the hood on the Indian banking system. Let's start with the most basic question, which I think people often gloss over because they just assume they know the answer.
Yeah, they picture a building with an ATM.
Exactly. What actually defines a bank? Is it just that building?
It's a bit more specific than that. At its core, according to the texts, a bank is a financial intermediary.
And an intermediary, so a middleman.
Yes, a middleman. It sits between two groups of people who would otherwise never meet. On one side, you have people with excess money, savers. They want to keep their money safe and maybe earn a little return.
So they deposit their money into the bank.
Right. And on the other side, you have people who need money for productive purposes. Entrepreneurs, home buyers, factory owners.
So the bank takes the money from the saver, pays them a small interest rate, lends it to the borrower, charges them a higher interest rate, and keeps the difference.
That is the fundamental business model right there. That difference is called the spread. But the key legal definition in India also involves the obligation to honor checks.
Oh, really?
Yeah. If you put money in, you have the right to demand it back via a check or draft. That distinguishes a bank from, say, a mutual fund or a chit fund.
That is a crucial distinction for UPSC prelims. And overseeing this entire circus is the apex body, the Reserve Bank of India.
The big boss, the regulator.
When did the RBI actually come into the picture? Because I feel like it has just always been there.
It feels that way. But it was established on April 1st, 1935, under the Reserve Bank of India Act of 1934.
Okay, 1935.
But here is a detail from the text that surprises people. When it started, it was a private entity. It was a shareholders' bank.
Wait, really? Private individuals owned the Central Bank of India?
Yes, initially. It wasn't until 1949, after independence, that it was nationalized and became fully owned by the government of India.
That makes total sense. You don't want the people controlling the entire money supply to be worried about their quarterly dividends.
Exactly. A central bank needs to align its goals with the nation's economic policy, not private profit.
Now, when we look at the hierarchy of banks below the RBI, we often hear this term scheduled banks. It sounds very official, like they have a strict calendar or something. What does that actually mean?
It is official, but it has nothing to do with a calendar. A scheduled bank is simply a bank that is listed in the second schedule of the RBI Act, 1934.
The second schedule.
Think of it as the VIP list of banking.
Okay, so there is literally a list in the Act. How do you get on this VIP list?
Historically, the criteria were that you had to have a paid-up capital and reserves of at least 0.5 million rupees.
Wait, 0.5 million. That's 5 lakhs.
Yes, 5 lakhs.
5 lakhs. That sounds incredibly low by today's standards. You can barely buy a decent hatchback car for 5 lakhs now.
It does sound low now, but remember, this was 1934. The value of money was vastly different.
True.
But the more important criterion, the one that still matters immensely, is that they must satisfy the RBI, that their affairs are not being conducted in a manner that is detrimental to the interests of the depositors.
So it's a stamp of approval. It means the RBI has looked at you and said, okay, you are not a scam.
Precisely. And being scheduled gives you privileges. You get access to the RBI's liquidity windows, you can borrow money from the RBI, you get clearinghouse facilities.
And if you aren't on that list,
then you are a non-scheduled bank.
Are there many of those left?
They are quite rare these days in the commercial space, but they exist. They are kind of like the Wild West. They have much more limited operations. They aren't allowed to deal in foreign exchange. And honestly, as a depositor, you should be much more cautious.
Got it. Stick to the schedule. Now, within this scheduled category, Sanjeev Verma breaks down scheduled commercial banks, or SCBs. This seems to be where the main action is. Break this down for us because there are so many types.
The SCBs are the heavy lifters of the economy. We classify them based on who owns them. First, and historically the most dominant, are the public sector banks.
Oh.
The PSBs.
These are the government banks.
Yes. The government of India holds a majority stake. That means more than 51%.
Like SBI.
The biggest example, of course, is the State Bank of India, along with others like Bank of India, Canara Bank, and Punjab National Bank.
What about IDBI? I always see conflicting information on that.
IDBI is an interesting case in the study material. It was included in the PSB category since 2004, but recently LIC took a majority stake, and there's talk of privatization. But for the purpose of general classification in UPSC, it has historically been treated as a PSB, though its current status is legally private post-LIC acquisition. It's still treated as a quasi-public entity in function. It's a bit of a hybrid right now.
Okay, sticking to the clear-cut ones. Then we have the private sector banks.
These are owned by private individuals or corporations. They are limited liability companies.
And Sanjeev Verma splits them up, right?
Yes, we usually split them into 2 generations. The old private banks are those that existed before the 1991 reforms. Banks like Federal Bank or South Indian Bank. They tend to be a bit more conservative in their approach.
And the new generation.
These came up after the 1993 guidelines, following liberalization. HDFC, ICICI, Access. These are the ones with the slick apps, the aggressive marketing, and the massive growth in the last 2 decades.
Right. Then we have foreign banks.
These are international banks that have a presence in India. They operate either through branches, like Citibank used to, or HSBC, or as wholly owned subsidiaries.
Who do they lend to? Normal people.
Not usually. They bring in global practices, but focus mostly on niche, high-net-worth clients or massive corporate banking.
And there's one more category that I feel is super important for India specifically. The regional rural banks. The RRBs.
This is vital for India. These were established on October 2, 1975.
Why did we need them if we already had public sector banks?
The goal was very specific. Commercial banks were too urban-focused and cooperatives were too weak financially. We needed a hybrid. We needed a bank that had the professional management of a commercial bank, but the local feel of a cooperative.
The best of both worlds. But the ownership structure is tricky here, isn't it? It's not just the central government.
Correct. And this is a potential prelims trap. It is a 3-way split.
Break it down for me.
50% is held by the central government, 15% is held by the state government concerned, and 35% is held by a sponsor bank.
A sponsor bank, like a larger PSB.
Usually a large public sector bank like SBI or PNB that provides the technical expertise and backing.
So let me get this straight. If SBI sponsors an RRB in a district in Uttar Pradesh, SBI owns 35% of it, the center owns 50%, and the UP government owns 15%.
Precisely. And their focus is strictly on rural credit, agriculture, and weaker sections. They are the financial lifeline for the hinterland.
Now, sitting slightly to the side of these commercial banks, we have cooperative banks. How are they different? Is it just a different name, or is the core philosophy different?
The philosophy is fundamentally different. While scheduled commercial banks work on a commercial motive, which is profit maximization, cooperative banks work on a no-profit, no-loss principle.
Service over profit.
That is the idea. They are formed by members to serve members, but structurally they are a bit complex because they suffer from something called dual control.
Dual control. Two bosses.
Yes. They are registered under the Cooperative Societies Act, so the Registrar of Cooperative Societies, who is a state government official, handles their management, elections, and administration.
Okay, that's one boss.
But their banking functions, licensing, interest rates, all of that are regulated by the RBI.
That sounds like a recipe for conflict.
It often is. It has made regulation difficult, leading to some high-profile scams in the cooperative sector recently. But historically, they have been crucial for last-mile connectivity.
True.
And just a bit of trivia from the texts, the Ananya Cooperative Bank Limited in Vadodara was the first cooperative bank in India.
I love those little nuggets. Good for prelims. Okay, so we have the architecture laid out. We have the RBI at the top, the scheduled banks, the breakdown of public, private, foreign, RRBs, and the cooperatives.
The whole map.
But this system didn't just appear out of nowhere in its current form. It went through a massive, painful shift. Let's move to segment 2, the shift. Major banking sector reforms.
This is really the story of two eras. You have the pre-1991 era and the post-1991 era. To understand the reforms, you have to understand the mess we were in before 1991.
Paint the picture for us. What was it like walking into a bank or running a bank in 1985?
It was lazy banking at its peak. The sector was incredibly sheltered and highly regulated. The government treated banks essentially as a piggy bank to finance its own deficit.
How so? Like they just took the money.
Through high reserve ratios. The CRR, cash reserve ratio, and SLR, statutory liquidity ratio, were astronomically high.
How high is astronomical?
At one point, for every 100 rupees a bank took as a deposit, nearly 63 rupees had to be locked away with the RBI or invested in government bonds.
Wait, 63%. So they only had 37 rupees left to lend to actual businesses.
Exactly. And even for that 37 rupees, the RBI would tell them who to lend to and at what exact interest rate. It was called administered interest rates.
So the banks had zero freedom.
None. Banks couldn't set their own deposit rates and they couldn't set their own lending rates. There was no competition, no innovation, and customer service was basically non-existent. You'd stand in line for hours just to update a passbook.
So 1991 happens, the balance of payments crisis. The economy opens up. We realized our banking system was a dinosaur. Enter the Narasimham Committee.
The Narasimham Committee, both I in 1991 and Aditan in 1998, is the architect of modern Indian banking. They looked at this dinosaur and said, we need to evolve or we will die.
Let's unpack their big recommendations as detailed in Sanjeev Verma. What was the first major change?
Recommendation 1 was liberal entry. They said, stop protecting the public sector banks. Let private banks in. Let foreign banks in.
Just open the floodgates.
The idea was that competition would force the sleepy PSBs to wake up and become efficient. If the bank next door has air conditioning and fast service, you have to upgrade or lose your customers.
And that gave us the HDFCs and ICICIs we talked about earlier. What about the government control over the public banks?
Recommendation 2 was autonomy. The committee said the government needs to stop micromanaging. PSB should function independently within a broad RBI framework.
So no more political favors.
Exactly. The finance ministry shouldn't be calling up bank managers telling them to approve a bad loan for a politician's nephew. It was a move towards real professionalism.
But for me, the one that affects the common man the most is the interest rates.
Recommendation 3, deregulation of interest rates. This was huge. The committee said, let the market decide. Banks should be free to set deposit rates and lending rates based on supply and demand.
Now, Vivek Singh's book goes into a lot of detail on how this evolved, right?
Yeah.
We went from something called BPLR to base rate to MCLR. Can we clarify this alphabet soup? Why do we need so many versions?
It is a story of trial and error. Originally, after deregulation, we had the BPLR, benchmark prime lending rate.
Prime lending. Sounds fancy.
It was supposed to be the rate for the most credit-worthy customers, the best rate for the best borrowers, but it was opaque. Banks would lend below the BPLR to their favorite massive corporate clients while charging you and me much higher rates. It became a meaningless number.
So the RBI scrapped it.
Right. Then came the base rate. This was designed as a hard floor rate. Banks were told you cannot lend below this rate to absolutely anyone.
Okay, that brings some fairness.
It brought transparency, yes, but there was still a major problem, transmission.
Transmission, you mean like a car transmission?
Similar concept. If the engine, the RBI speeds up or slows down, do the wheels, the borrowers feel it?
Oh, I see.
If the RBI cut the repo rate to make loans cheaper and boost the economy, banks wouldn't pass that benefit to the customers. They would keep their base rate high to protect their own profit margins.
Sneaky. So how did the RBI fix that broken transmission?
On April 1st, 2016, the RBI introduced MCLR, Marginal Cost of Funds-Based Lending Rate.
Marginal. That usually means extra or new in economics, right?
Spot on. It means the cost of raising new funds. Under base rate, banks calculated their costs based on the average of all their old historical deposits.
Which moves very slowly.
Exactly. But under MCLR, they have to calculate the cost based on the current interest rate for new deposits.
So if the RBI cuts rates today,
the cost of new deposits drops immediately, and the MCLR formula forces the bank to lower the lending rate for borrowers much faster.
that is a huge improvement for the consumer. It forces the bank to be honest about their current costs. Okay, what else did Nira Simham recommend?
Transparency regarding bad loans. Before this, banks used to hide their non-performing assets, or NPAs, using accounting tricks.
Hiding bad loans. How?
They would lend more money to a defaulting borrower just so the borrower could use that new money to pay the interest on the old loan. It's called evergreening.
That is exactly like using a new credit card to pay off your old credit card.
It is a recipe for disaster. The committee said, no more. We need full disclosure. They standardized the definition of an NPA to the 90-day rule, which we will discuss in depth later.
Okay.
And finally, perhaps the most technical but critical recommendation, capital adequacy norms. This brings us to the Basel standard.
Yes, Basel. This is where a lot of people zone out because it sounds like incredibly boring international regulation.
Yeah.
But it is actually the safety net that keeps our money from vanishing into thin air. Let's move to segment 3. Safety first, capital adequacy, and Basel norms.
It is safety first, indeed.
So let's ask the stupid question. Banks lend other people's money. I deposit my salary. They lend it to a business. Why do they need their own money? Why does the regulator care how much capital the bank owner actually has?
That is the fundamental question of banking regulation. Think of it this way. Lending is an inherently risky business. What if that business defaults? What if the factory burns down and they can't pay?
Well, technically the depositor's money was lent out, so it's gone.
Right. And if the bank turns around and tells the depositors, sorry, we lost your retirement savings because that one factory failed, what happens?
You get a bank run. Everyone panics and tries to pull their money out at once.
And the bank collapses. Panic spreads to other banks. The entire economy crashes.
Okay, that is a nightmare scenario.
To prevent this, regulators say to the bank owners, you need a buffer. You need your own skin in the game. If a loan goes bad, you first wipe out your own capital before you even touch a single rupee of the depositor's money. This buffer is called capital adequacy.
And this is measured by the CRAR.
Yes, the capital to risk-weighted assets ratio.
Okay, before we get to the math of that, tell me about Basel. Why is a city in Switzerland dictating Indian banking rules?
Basel is the headquarters of the BIS, the Bank for International Settlements. Think of it as the central bank for central banks.
Okay.
It is where the RBI governor meets with the chair of the U.S. Federal Reserve and others to agree on global safety standards so the global financial system doesn't blow up.
And they came up with these norms.
3 sets of them over the years. Basel I came in 1988, and India adopted it in 1999. It was a good start, but very simple. It focused purely on credit risk, the risk of a borrower simply not paying back. It set a minimum capital requirement of 8%.
Then came Basel II.
In 2004, it was more sophisticated. It introduced 3 pillars.
What are the pillars?
Pillar 1 was the minimum capital requirement, staying at 8%. Pillar 2 was supervisory review. This meant banks need better internal risk management models, and the RBI needs to watch them much more closely.
And Pillar 3?
Market discipline.
Market discipline. What does that mean in practice?
It means forcing banks to publicly disclose their data. If a bank is making risky bets, the market, meaning investors, should know about it so they can punish the bank by selling its shares.
Transparency. But then the world crashed in 2008. The global financial crisis. Lehman Brothers collapsed. Clearly, Basel II wasn't enough to save them.
Exactly. The 2008 crisis showed that banks didn't just fail because of bad loans, which is credit risk. They failed because they literally ran out of cash to meet daily obligations. That's liquidity risk. Or they had borrowed way too much money to invest. That's leverage.
So they needed a bigger shield.
So Basel III was introduced in 2010. It is like upgrading from a wooden shield to full Kevlar body armor. It covers liquidity, leverage, and the quality of capital.
And what is the number for India? Did we stick to the 8%?
While the global Basel III standard is 8%, the RBI acts like a very conservative parent. They prescribe 9% for Indian banks. We like to be extra safe.
I like extra safe. Okay, I want to visualize this CRER calculation. Vivek Singh has a great example in his book, and I want to walk through it slowly because the math here really confuses people.
Let's do it. It's actually quite elegant once you see it. Imagine a small bank. Let's call it Bank A.
Bank A, got it.
Bank A has total funds of 4 crores. Out of this 4 crores, 1 crore is the owner's money. That's equity or capital.
Okay, so 1 crore of their own money.
And 3 crores are deposits from the public. That's a liability.
Pausing to visualize. 1 crore own money, 3 crores public money. Total 4 crores sitting in the vault.
Now, a bank doesn't just sit on cash, it lends 4 crores out. Let's say it lends 1 crore to me as a personal loan.
Okay.
Personal loans are inherently risky. I gave no collateral. If I run away, the money is just gone. So the regulator assigns a risk weight of 100% to that loan.
So that entire 1 crore is considered fully at risk.
Correct. So your risk-weighted asset for that loan is 1 crore.
Yeah.
Now, the remaining 3 crores, the bank lends out as housing loans, mortgages.
Those are safe erases.
Much safer. There is a physical house as collateral. If the borrower defaults, the bank can seize and sell the house to recover the money. So the regulator says the risk weight for this is only 50%.
Okay, let me do the math. So for the 3 crores lent out for housing, we only count 50% of it as risky. 50% of 3 crores is 1.5 crores.
Exactly. So let's sum up the total risk-weighted assets for Bank A. You have 1 crore from the personal loan plus 1.5 crores from the housing loans.
Total risk-weighted assets equals 2.5 crores.
Perfect. Now you have 2.5 crores of risk, and how much of your own capital did you have?
We started with 1 crore of our own capital.
So how do you find the CRI ratio? You divide your capital by the risk-weighted assets.
1 crore divided by 2.5 crores. That equals 0.40, or 40%.
40%. That is way above the RBI's 9% requirement. Bank A is super safe.
It is rock solid.
But imagine if they had lent all 4 crores to risky personal borrowers with 100% risk weight. Then the denominator would be the full 4 crores. 1 divided by 4 is 25%.
Still safe, but significantly lower.
Now imagine they had very little of their own capital, say only 10 lakhs, which is 0.1 crore. Then the ratio would plummet. If that ratio drops below 9%, the RBI steps in, rings the alarm, and takes control of the bank.
That example makes it so much clearer. It's not just about how much total money you lend, but who you lend to, how risky they are, and how much cushion you have to absorb the shock.
Exactly. Risk-weighted.
One last technical term before we move on from capital. Tier 1 and Tier 2 capital. I hear this on the business news all the time. A headline will say, bank raises Tier 1 capital. What does that actually mean?
Think of Tier 1 as core capital. This is the solid, undeniable stuff. Equity shares, retained earnings. It is money that stays with the bank forever. It can absorb losses immediately while the bank keeps its doors open and keeps running.
And Tier 2?
Tier 2 is supplementary. It includes things like revaluation reserves.
What's a revaluation reserve?
Say the bank owns a headquarters building they bought for 10 crores 20 years ago. Today it's worth 100 crores. That 90 crore increase is a revaluation reserve. It's value on paper. It also includes subordinated debt. It's much less reliable. It's harder to instantly use to cover a sudden cash loss.
So Tier 1 is the actual cash in your pocket, and Tier 2 is the potential value of your vintage watch.
That's a very decent analogy, and the rule is strict. Tier 2 cannot exceed 100% of Tier 1.
Meaning you can't build a bank just on the value of your watch. You need actual cash.
You need cash. You need a solid core.
Got it. Solid core. Safety buffer. That is the bank's internal health. But the RBI also manages the external environment, the actual amount of money flowing through the entire system. Let's move to segment 4. The control room. liquidity management by the RBI.
This is the RBI's daily tightrope work. They're constantly trying to balance two opposing economic forces, growth and inflation.
Right. Growth needs liquidity. Cheap money to build factories, hire workers, and buy homes. But too much money chasing too few goods gives you high inflation.
Precisely. So the RBI acts like a master plumber, controlling the flow of water, which is money, in the pipes, which is the economy. They have a massive toolkit. We divide these tools into quantitative tools, which control the sheer volume of money, and qualitative tools, which control the direction of that money.
The quantitative ones are the heavy hitters, right? Let's run through the big ones. First up, CRR, cash reserve ratio. We mentioned this earlier.
CRR is the blunt instrument. It is the percentage of net demand and time liabilities, or NDTL, basically, a bank's total deposits that banks must keep strictly as cash with the RBI.
With the RBI is a key phrase here. It physically leaves the bank's vault. Does the RBI pay interest on this parked cash?
No, that is the kicker. It pays zero interest. It's completely dead money for the bank.
So how does it control inflation?
If the RBI sees inflation rising, they raise the CRR from, say, 4% to 5%. Suddenly, huge amounts of cash are sucked out of the banking system and locked up in the RBI vaults.
Banks have less money to lend.
Exactly. Since banks have less to lend, they charge higher interest rates. Loans get expensive, people borrow less, spend less, and inflation cools down. It's a giant vacuum cleaner for liquidity.
Next is SLR, statutory liquidity ratio.
This is similar in concept, but the money stays with the bank itself. The bank must keep a certain percentage of its deposits in safe, highly liquid assets, like cash, gold, or unencumbered government securities.
So this acts as a solvency buffer. If depositors come rushing back in a panic, the bank has these safe assets to sell quickly and give people their money back.
Ideally, yes. That's the textbook definition. But in India, historically, SLR has been used for a very different practical purpose.
Which is?
Since banks overwhelmingly choose to buy government securities to meet their SLR requirement, it effectively forces banks to lend money to the government. It ensures the government always has a guaranteed buyer for its debt to fund its fiscal deficit.
Ah, a captive market for government borrowing. That's clever.
Yeah.
Now let's talk about the tool they use most actively to tweak daily liquidity, FOMO, or open market operations.
This is straightforward buying and selling of government securities in the secondary market by the RBI.
How does it impact liquidity?
If the RBI wants to inject liquidity, add water to the pipes, it buys securities from banks. The RBI takes the paper bond and hands the bank cold, hard cash.
Bank has more cash, lends more, interest rates drop.
Exactly. And if they want to suck liquidity out,
They sell securities. The banks give the RBI cash to buy the bonds. Cash leaves the system and interest rates rise.
simple and effective. But the real headline grabber, the number that flashes in red on every business news channel, is the repo rate. This falls under the LAF, Liquidity Adjustment Facility.
LAF.
The LAF is the primary instrument today. It allows banks to manage their day-to-day, short-term cash mismatches.
Break down the repo rate.
Repo stands for repurchase option.
Okay.
It is the rate at which banks borrow from the RBI for the short term. Mechanically, the bank sells its government securities to the RBI with a strict legal agreement to repurchase them later at a slightly higher price.
And that difference in price is effectively the interest rate.
Exactly. This is the policy rate.
Why is it called the policy rate? Why is it so important?
Because it sets the benchmark for the entire economy. If the repo rate goes up, the fundamental cost of funds for banks goes up. They don't absorb that cost. They pass it to you and me.
So my EMI goes up.
Your home loan gets expensive. Corporate loans get expensive. Businesses stop expanding. Investment slows down. And eventually, inflation drops.
And the reverse of that is the reverse repo.
Yes, that is technically the rate at which the RBI borrows from banks. But really, practically, it is where banks park their excess cash.
Why would they do that?
If a bank has 100 crores sitting idle at the end of the day and no safe borrower to lend to, they park it overnight with the RBI and earn the reverse repo rate. It's better than earning zero.
And Vivek Singh points out this creates a corridor, right?
Yes, the LAF corridor.
Yeah.
The repo rate is the ceiling, the maximum cost for a bank to borrow. The reverse repo rate is the floor, the minimum return on idle cash. Short-term market interest rates usually fluctuate right between these two numbers.
That corridor visualization helps a lot. But what if a bank is in desperate deep trouble? They have used up their entire repo limit. They have no more eligible securities. They are completely out of options.
Then they run to the MSF, Marginal Standing Facility. It is the ultimate emergency window.
Is it expensive?
Yes, the rate is higher. It is a penal rate. And importantly, to borrow under normal repo, you cannot touch your SLR quota securities. Those are sacred.
Right, the 18% or whatever that is locked up.
But under MSF, the RBI says, okay, this is an emergency. We will allow you to dip into your SLR quota up to a certain limit to pledge those securities and get cash to survive the night. It is literally the break glass in case of emergency option.
Okay, so the RBI controls the total volume of money. But here's the problem with relying purely on volume. Gravity naturally pulls that water, that money, towards the big cities and the massive corporations. It is easier to give one loan of 1,000 crores to a giant conglomerate than 1 million loans of 1,000 rupees to farmers.
Much easier and much cheaper administratively.
Money doesn't naturally flow uphill to the villages or the small workshops. So how does the government force the water uphill? That is where we get into segment 5. Banking with a purpose. Directed lending.
This brings us back to the social obligation of banking in a developing nation. If you leave it entirely to the free market, banks would only lend to Reliance, Tata, and Adani. It is safer, it is easier, and it is highly profitable.
Who would lend to the small farmer in Vidarbha or the handloom weaver in Varanasi?
Or the student needing a small education loan to go to college.
Exactly.
So the RBI instituted priority sector lending, or PSL. The mandate is strict. Domestic scheduled commercial banks and foreign banks with more than 20 branches must lend 40% of their adjusted net bank credit, their A and BC, to these priority sectors.
40% is a massive chunk of the pie. That's almost half their entire lending book. What specific sectors are we talking about here?
Agriculture is the big one. It has a very specific sub-target of 18%. Then there are MSMEs, which are micro, small, and medium enterprises, export credit, education loans, housing for the poor, social infrastructure like rural clinics, and renewable energy.
Are there targets within targets?
Yes, there is also a specific 10% target strictly for weaker sections to ensure the money reaches the absolute poorest of the poor, not just rich farmers.
Now let's play devil's advocate for a second. Banks are profit-driven entities with shareholders. Dealing with thousands of small rural loans is administratively expensive and carries a high risk of default. What if a bank manager in Mumbai says, "Sorry, RBI, I honestly couldn't find enough eligible farmers to lend to this year"? What if they miss the 40% target?
They cannot just shrug it off. The RBI has a big stick. If they miss the target, they are penalized. They have to deposit the exact shortfall amount into the RIDF, the Rural Infrastructure Development Fund.
And who manages this fund?
NABARD, the National Bank for Agriculture and Rural Development. This fund was established back in 1995-96.
So walk me through the mechanics of that penalty.
Sure. Let's say Bank A has a target to lend 1,000 crores to agriculture, but they only manage 900 crores. They missed it by 100 crores. They're forced to give that 100 crores to NABARD's RIDF.
Do they lose the money?
No, it's a deposit. But NABARD pays the bank a very, very low interest rate on this money, much lower than what the bank could have earned by lending it commercially or even buying government bonds.
So it hits them where it hurts, their profit margins.
Exactly. And then what does NABARD do with that huge pool of penalty money? They take it and lend it to state governments at cheap rates to build actual physical rural infrastructure, irrigation canals, rural roads, cold storage warehouses.
That is brilliant. So the money eventually reaches the rural economy one way or another. Either the bank does the hard work and lends it directly to the farmer, or it goes through NABARD to build the road the farmer uses to take his crops to the market.
Exactly. The system is designed to ensure the rural sector isn't starved of capital, regardless of the bank's preferences.
Speaking of starving for capital, for decades, a huge chunk of India's population had no access to banks at all. No savings accounts, no formal credit, just cash hidden under the mattress. Let's move to segment 6, financial inclusion and new banking models. This has been a massive buzzword for the last decade.
It absolutely has. The core philosophy of financial inclusion is simple. You have to connect the unbanked to the economic mainstream.
Why is it so critical?
Because if you don't have a bank account, you are effectively a ghost in the formal economy. You can't safely save, you can't get insurance, you can't get cheap formal loans. When you need money for a medical emergency, you are completely vulnerable to local moneylenders charging 50% interest.
The biggest driver to fix this recently was PMJDY, Pradhan Mantri Jan Dhan Yojana.
It was a total game changer. Launched in 2014, it aggressively addressed the supply-side barriers to banking.
What did it offer to convince people to open accounts?
It offered zero balance accounts, known technically as basic savings bank deposit accounts. It gave them Rupee debit cards, free accident insurance, and even a small overdraft facility of 10,000 rupees. In a few years, it brought hundreds of millions of people into the formal banking system.
And this massive database of accounts enabled the Jam Trinity.
The Jam Trinity, Jan Dhan, Aadhaar, and mobile. This combination revolutionized direct benefit transfer, or DBT.
How did it work before Jam?
Before this, if the government wanted to send 100 rupees for a drought relief program to a poor farmer, it went through layers of bureaucracy. Maybe 15 rupees actually reached the farmer. The rest leaked out as corruption or administrative waste.
And now?
Now, with Jam, the government pushes a button in Delhi, and the money lands directly in the beneficiary's Jan Dhan account linked to their Aadhaar. Zero leakage.
But even with Jan Dhan accounts everywhere, the RBI realized that traditional big banks, the elephants of the sector like SBI or HDOC, aren't always good at dancing. They aren't great at reaching the extreme last mile or catering to micro needs.
So, based on the recommendations of the Nachikit Moore Committee, the RBI introduced differentiated banks, niche banking.
Right, we got two main types of these specialized banks. First, small finance banks, or SFBs. How do they work?
Think of SFBs as miniature versions of regular commercial banks. Their stated objective is to lend strictly to unserved and underserved sections. Small business units, small and marginal farmers, micro-industries.
Can they accept deposits like a normal bank?
Yes, they are full banks in that sense. They can accept deposits from the public, and they can lend money out.
So what makes them different from a regular bank?
Because their entire reason for existing is financial inclusion, they have a much tougher lending mandate. 75% of their total lending must go to the priority sector.
75%. Compare that to the 40% for normal banks. That is huge.
It is a heavy mandate. Examples you might see around are Small Finance Bank, Ujjivan, or Equitas. Many of these actually started as microfinance institutions and then upgraded their licenses to become banks.
Got it. Then you have the second type, which I find really interesting, payments banks.
These are highly unique. Their goal is purely to facilitate payments and remittance services. Think of migrant workers in Mumbai needing a cheap, safe way to send money home to their families in Bihar.
How are they different from SFBs?
This is the crucial distinction for exams. Payments banks can accept deposits, currently up to a limit of 2 lakh rupees per customer, but they absolutely cannot lend.
No lending at all, not even small loans.
Zero lending. They cannot issue credit cards, they cannot give out personal loans or business loans, they carry zero credit risk.
But wait, if they can't lend, they can't earn interest from borrowers. So how do they ensure the depositor's money is safe, and how do they make any profit?
To keep the money safe, the RBI mandates they must invest 75% of all their deposits straight into ultra-safe government securities.
Okay, so the money is parked with the government.
Yes. And they make money through transaction fees, cross-selling other financial products like third-party insurance or mutual funds, and earning the interest on those government bonds.
Examples would be Airtel Payments Bank or India Post Payments Bank.
Or Paytm Payments Bank, before it ran into severe regulatory issues with the RBI recently. They are essentially digital wallets wrapped in a banking license.
Moving on from digital money, speaking of assets sitting idle, Sanjeev Verma also highlights the gold monetization scheme. We Indians love our gold. We're culturally obsessed with it.
We hoard it. Estimates suggest Indian households and temples hold over 20,000 tons of gold.
That's a staggering amount of wealth.
But from an economic standpoint, gold sitting in a locker is dead capital. It doesn't build roads, it doesn't fund factories, it generates no economic activity. Plus, we have to import almost all of it, which drains our foreign exchange and hurts our current account deficit.
So how does this scheme try to fix that?
The gold monetization scheme allows you to deposit your idle gold jewelry or coins with a bank. The bank melts it down, checks the purity, and gives you a certificate. You then earn regular interest on the value of that gold.
And when the term is up?
When you redeem it, you can choose to get the equivalent cash value or get physical gold back. It turns a dead asset into a financial asset.
Turning jewelry into GDP. I like it. But now we have to talk about the dark side. The massive elephant in the room that almost crushed the entire Indian banking system a few years ago. Segment 7. The crisis and the cure. NPAs.
This has been the single biggest headache for the Indian banking sector, specifically the public sector banks, for the last decade. It led to what the economic survey famously called the twin balance sheet problem: over-leveraged companies and bad loan-laden banks.
Let's define it clearly again. Non-performing asset, NPA.
An asset which, for a bank as a loan, becomes non-performing if the interest or the principal installment is overdue for 90 days.
90 days. It is a strict, hard timeline. Day 91, the computer flags it. It's an NPA.
Exactly.
And once it's classified as an NPA, what happens? There are categories, right?
Yes, the deterioration is tracked. For the first 12 months that it remains an NPA, it is classified as substandard.
Substandard.
If it remains an NPA for more than 12 months, it is downgraded to doubtful.
Doubtful, meaning recovery is highly unlikely.
And finally, if the bank's internal auditor or an RBI inspector formally identifies that the money cannot be recovered at all, it is classified as a loss asset. It has to be entirely written off the books.
So what have we done to fix this mess? We couldn't just sit there and let the banks bleed out.
We have thrown the proverbial kitchen sink at it, a whole series of legal and structural reforms. First, going back historically, we had the Sarfazi Act of 2002.
Sarfazi.
What did that do?
Before Sarfazi, banks were practically toothless. If a rich businessman defaulted on a massive loan, the bank had to file a case in a regular civil court. The borrower's lawyers would drag the case on for 15 or 20 years. Meanwhile, the borrower is still living in the mansion or running the factory they didn't pay for.
That's infuriating.
Sarfazi bypassed that. It empowered banks to seize, manage, and auction off secured assets like real estate to recover their dues without requiring court intervention.
That gave banks some real teeth. But clearly the problem persisted into the 2010s. Yes, because corporate structures got more complex. So fast forward to 2015, the government launched the Indradhanush Plan. It was a comprehensive, 7-pronged strategy to revamp and recapitalize public sector banks. The mnemonic for exams is ABCDEFG.
I love a good mnemonic. Let's run through it quickly. A is for
Appointments. They split the very powerful post of CMD into two: a managing director who acts as CEO and a non-executive chairman. It improved corporate governance. The Bank Board Bureau, or BBB. It has now been replaced by the FSE, the Financial Services Institutions Bureau. The idea was to select top management professionally and transparently, taking the politics out of bank appointments.
C.
Capitalization. This is the government infusing thousands of crores of taxpayer money into the banks just to keep them afloat and meet those Basel Norms we talked about earlier.
D is for de-stressing.
Exactly. Setting up frameworks to solve the bad loan issues, particularly in stress sectors like infrastructure and power.
All right. E, F, and G.
E is for empowerment. The government formally promising no political interference in commercial lending decisions. Let bankers be bankers. F is framework of accountability, setting strict key performance indicators, or KPIs, for bank chiefs. If you don't perform, you don't get your bonus. And G is governance reforms, like the giant Sangha meetings where top bankers and government officials brainstormed strategy together.
It was comprehensive. But the real sledgehammer, the reform that actually terrified the big, untouchable corporate defaulters, was the IBC, the Insolvency and Bankruptcy Code of 2016.
The IBC changed the fundamental power dynamic of Indian business. Before the IBC, we operated on a debtor in possession system.
What does that mean?
It means if I owned a massive steel plant and defaulted on my 5,000 crore loan, I still stayed in charge of the plant while I fought the bank in court for a decade. I controlled the assets.
And the IBC flipped that.
It shifted it to creditor in control. Under IDC, if a company defaults, the bank can drag them to the NCLT, the National Company Law Tribunal.
And what happens there?
The tribunal immediately appoints an insolvency professional to take over the entire management of the company. The existing board of directors is suspended. The promoters are locked out of their own offices.
That is brutal.
And it is strictly time-bound. The original framework gave them 180 days, extendable to 270 days. The creditors form a committee. The suspended management has to come up with a repayment plan that the creditors agree to. If they can't agree within the timeline, the company is forcibly liquidated and sold for parts.
It finally meant billionaire promoters could actually lose their prized companies. That fear alone forced a lot of hidden money out of the woodwork to clear debts.
That's revolutionary.
And finally, the newest structural tool in the box for dealing with legacy bad loans: the bad bank.
This is the ultimate cleanup crew. To handle the worst of the worst loans, the government established a dual structure: NRCL and IDRCL.
Let's split them up. NRCL first.
NRCL stands for National Asset Reconstruction Company, Ltd. This is the actual bad bank. It acts as an aggregator. It goes to SBI, PNB, and says, give me all your toxic, unrecoverable, large corporate loans. I will buy them from you at a discount.
So the regular bank's balance sheet instantly becomes clean. They can stop stressing about recovery and focus purely on lending to new, healthy businesses.
Yes, NRCL pays the banks 15% of the agreed value up front in cash and the remaining 85% in security receipts, which are crucially guaranteed by the central government.
Okay, so NRCL now owns a giant pile of toxic debt. What does IDRCL do?
IDRCL is the India Debt Resolution Company, Ltd. This is the specialized selling agent. While NRCL owns the debt, IDRCL provides the market expertise. Their only job is to find buyers for these distressed assets, try to turn the companies around, or sell the scrap metal to recover whatever value is left.
It's like hiring a specialized hazmat team to clean up a toxic waste dump so the rest of the city can breathe.
Exactly.
Now, looking at the sheer terrifying size of these financial problems, the government decided that maybe small and beautiful doesn't apply to global banking. They wanted absolute giants that could weather any storm. This brings us to Segment 8, Consolidation. The SBI merger.
This was a historic, monumental move that became effective on April 1st, 2017. The State Bank of India merged with its 5 associate banks.
That's banks like State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Mysore, Patiala, and Travancore.
Yes, those 5, plus the Bharatiya Mahila Bank, all merged into the mothership, SBI.
Why merge them? Why not keep them separate? I remember seeing State Bank of Travancore branches all over Kerala. They were massive, trusted institutions in their own right. People had emotional attachments to them.
It was very emotional for many employees and customers, but the harsh economic rationale was too strong to ignore. First, you have economies of scale.
Bigger is cheaper.
Yes. A bigger bank can negotiate much better technology deals for its core banking software. It can raise funds on the international market much more cheaply because it's seen as safer, and it drastically reduces administrative duplication at the corporate level.
And rationalization of branches.
That was huge. You literally had absurd situations where a main SBI branch and a State Bank of Hyderabad branch were physically right next door to each other, fully staffed, paying double rent, competing for the exact same local customer. And both were ultimately owned by the government of India. It was incredibly wasteful.
Consolidating them just makes operational sense. But there's a global angle here too, isn't there?
That is the big strategic ambition. The government desperately wanted to create a global-sized Indian bank.
Weren't they already big?
Even before the merger, SBI was huge inside India. But globally, it was relatively small compared to the absolute giants like ICBC or Bank of China or JP Morgan Chase and Citibank in the U.S. This merger forcefully pushed SBI into the top 50 banks globally by asset size.
Why does being top 50 matter?
Because size gives you the sheer balance sheet strength to single-handedly fund massive, multi-billion-dollar national infrastructure projects that a consortium of smaller banks couldn't safely touch.
Wow. So we have traveled a long, fascinating road today, from the basic definition of a bank acting as an intermediary to the incredibly complex machinery of Basel Norms and risk weights, to the high-stakes tightrope walk of the RBI's liquidity management using Repo and CRR, and the massive multi-year cleanup of NPAs.
It is an incredibly dynamic sector. It truly is the engine room of the economy. If the banking sector coughs, the entire economy catches a severe cold. We've seen how decades of reforms have shifted the power dynamic from the borrower to the saver, and from opaque backroom political deals to transparent, highly regulated digital systems.
It's a completely different world now. Here is a final provocative thought for you listeners to mull over as we wrap up. We just talked extensively about consolidation and creating massive brick-and-mortar megabanks like the new SBI. But with the explosive rise of fintech startups, pure digital payments banks, and now the serious development of a digital rupee, the CBDC, are physical brick-and-mortar bank branches destined to become museums? Or does the human touch in banking still fundamentally matter for the incredibly diverse, multilingual Indian population?
That is the trillion rupee question for the next decade. Technology brings undeniable scale and efficiency, but financial trust is often deeply human. In a country as vast and varied as India, I think the local branch manager still has a vital role to play, but their job description is definitely going to change radically. They will become financial advisors rather than just cashiers.
Something to definitely explore on your own. If this deep dive helped you connect the dots on the banking sector, please subscribe to the channel. It's the absolute best way to support the Simplified UPSC by PPP mission. We are trying to decode the entire syllabus like this, one complex chapter at a time.
And a huge thank you to our Patreon supporters. If you are capable, please join them to keep this content flowing. Your contribution allows us to buy better books, upgrade our equipment, and spend much more time researching to bring you the best possible summaries.
Don't forget, the free notes and those practice PYQs are waiting for you right now on the public Telegram channel. For the fully organized premium library with detailed notes, extra PYQs, and those crucial model mains answers, DM us to join the private group. Like, share, comment your thoughts, and keep learning. See you in the next deep dive.
Goodbye and happy learning.